Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 21st of May. I'm Daniel Lam, your host for the podcast. One of the key differences between Trump 2.0 versus 1.0 is the galaxy of top-notch experts that Trump had managed to attract into his cabinet. Scott Bessent, the Secretary of the Treasury, was a top hedge fund manager. Now recently, with the aura and experience of a top financial professional, Bessent brushed off Moody's downgrade of US sovereign as a quote-unquote lagging indicator. But to us mere mortals and laymen, it is worthwhile to think about this downgrade and how it can feed into US assets. So in short, the low positioning in US assets means that Moody's downgrade is unlikely to cause a lasting sell-off. Now, various indicators show that the positioning of US assets is still -1 standard deviation from long-term averages. Now for equities, yes, we have had the low-hanging fruit, with S&P 500 rebounding from just above the 5,000 level to where we are now. But as we talked about yesterday, it can grind higher to the 6,200 level. For the US 10-year government bond yield, it is interesting to note that volatility is not limited to US Treasuries. The bonds were selling off in tandem with US Treasuries, which is a stark contrast to a few weeks ago when there was a clear rotation out of US bonds into European government bonds. Now, from the price action, the markets are more focused upon the self-inflicted US policy uncertainties rather than such external downgrade to US sovereigns. Now, naturally, if the sovereign bond market in Euro area is moving in tandem with that in the US, then this lack of divergence, as well as the very light positioning in US assets, should limit the sell-off in US dollar. Now, in fact, during the prior credit downgrades, the US dollar traded sideways in the initial days after the news before rallying. From a positioning perspective, despite an uptick in net bullish option flows in recent weeks, the US dollar is still underowned relative to the 2011 or 2023 credit downgrade episodes, much more so against the major DM currencies such as the euro and the pound sterling. So overall, we continue to see the dollar being vulnerable to short squeeze, as we talked about in our podcast earlier this month. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.